Great. Well, welcome everybody. I know we will have a few stragglers coming in, but I'm very excited to welcome everybody to From Pitch to Progress, key takeaways from successful fundraising of ATMPs. I'm Phil Vanek. I'm a private equity investor and a board advisor with a number of affiliations, which I won't go into. But most recently, as of January, I'm also the Chief Commercialization Officer of ISCT. So I'm excited to be here today. I'm not going to talk too much, I promise. I just want to set the table a little bit. This is effectively a follow-on session from this morning's investor focus panel, but instead we have board members and investees, and I think that's going to give a really unique and interesting perspective for those of you who are going down this journey as well. Generally, to set this up, we'd argue that the public financing window is largely closed right now, for now, and private funding has been a challenge for a number. We heard that reflected in the call in the talks this morning. So we'll be joined by both a clinical stage and a commercial stage ARM board members to help kind of talk through how their successes might translate into good information for you. We have 30 minutes. We've set it up almost as a fireside chat style to make it efficient. I don't know if we'll have time for burning questions, but please find us afterwards. In that 30 minutes, we'll do our best to capture the mood of the industry in light of both current events as well as the world tariff frustrations. So I call that WTF, for those of you who are following along. Our goal is to come away with some practical advice for our members, even if we don't come away with any consensus in these dynamic times. But to kick it off, I'm going to ask to have each of our speakers give a brief introduction to their company and themselves. Robert.
Thanks very much for having me, Phil. These chairs are unusually comfortable, so if I fall asleep, just nudge me. I'm Robert Ang. I'm privileged to be CEO at a company called Vor Bio. We're a public cell therapy company making genome-engineered stem cell transplants and CAR-Ts for patients with AML and other blood cancers. We have had the fortune of raising a $42 million A round, then about 110 and a B. We IPO'd at the very peak of the market, which was January 2021, with a $206 million IPO. We did 2 public follow-ons since then, one of 116 million, more recently of 56. And I can certainly relate about the progression of pain as we've experienced subsequent financings, but great to be here.
Great. Chris?
I'm Chris Vann. I'm the Chief Operating Officer of Autolus. Autolus has actually gone from a preclinical spin-out from the University College London to a commercial company in just over 10 years and 1 month. During that process, we've been through various stages of financing. Obviously, we had a seed round of around £30 million, which was quite a big one for the UK. We then had a Series A, Series B, Series C. We had a mezzanine round. We IPO'd actually in 2018. We've had a couple of follow-on rounds. We've also raised money through different vehicles as well. Obviously, we've got a collaboration with BioNTech, and we've also got with BlackRock a form of, and both of the deals are a little bit more complicated than that, but a form of project financing as well. Over the course of the life of the company, we've raised somewhere in the region of $1.5 billion.
Yeah. No, it's the one takeaway that I've heard, it's not one and done funding rounds. You have to be very adaptive. So maybe we can unpack that a little bit. 2020, 2021 was kind of the heyday. People were almost, it was a frothy market. I think people were talking about the capital that was flowing in. But then you had to evolve and adapt very quickly. Maybe you can walk us through kind of that transition into the more difficult times and what was the mindset?
Yeah, so I mean, it's, I think, obvious to a lot of you, but during the heyday, 2020, 21, you could raise money on promise. And that's really what your pitch primarily was. It was promise. It was amazing technologies that have platform value towards a gazillion indications. It was, we can transform standard of care by doing this thing differently. We can radically change certain diseases through these novel approaches. And that sold, right? That sold very effectively in that era. This era, I would characterize as one where investors want a reason to say no. They're naturally far more pessimistic, and they're looking for the very true value creation milestone that, that you're facing as a company. And this is one key, I think, that I really want to emphasize here, is that you have to be realistic about what that true value creation milestone is. If you think it's early proof of concept in preclinical models, that ain't it. If you think even if it's early clinical proof of concept in the clinic, that's probably also not the case. You need to be realistic about exactly the kinds of data that you think will convince a skeptical investor that you're going to change that standard of care. And sometimes that might even require randomized data. But to be realistic about the amount of capital it would take to get to that milestone, and therefore how you're going to build value along the way with a financing strategy, I think is really key.
Yeah. Chris, how did your thinking evolve as you were building the technology, going forward to the market, competitive landscape, and then your need to adapt?
So I'm very fortunate that I have working in the company a CEO who's actually built a very big company, Micromed, which brought the first bite to market and actually exited a number of CFOs who have lots of experience. So we've had 3 CFOs in the time that I've been actually in Autolus. So I was involved in the IPO. I get involved in supporting the big transactions and some of the investor relations. What I've noticed in the time, though, that I've been engaged is there's really 2 periods. There's the period with the tailwind, which I would say around 21, 22, and then there's been a period with strong headwinds since. So I think that the early phase, raising money is never trivial. We can go through lots of the preparation steps that you better take to actually be able to raise money, but at that stage, the investors had an optimism. They saw the true value of what the technologies would bring. They saw the societal value, and we didn't need to actually work as hard on explaining that these products being transformational were going to be not just successful and taken up in the market, but they would also be highly valuable because they would actually generate a substantial improvement to society. And in that period, it would be fair to say the other factor that was quite interesting, I wouldn't say you were encouraged to have a broad platform, but the pendulum was very much towards having optionality, having several options that you could take to market. Somewhere around 22 it started, and we're clearly in a highly turbulent period at the moment. I think what's changed since that period is you are very much now valued narrowly according to the technology that is your lead technology. So I think the valuations very much follow a single asset, even in companies that actually have established both multiple assets, capabilities, and platforms. So I think that's something that we need to bear in mind as an industry. And I also think that Robert calls it looking to fail. I would say it's rather show me the value. So where's the inflection point? What is the inflection point? Is it a potential exit? Is it actually going onto the market? And I think we're still in an area now where the industry actually has to demonstrate the value of the assets, not just take the asset and have it imputed by the investors, but we also have to be very practical. This is what we're going to do with the proceeds. This is the value inflection. This is the tangible assessment of what that opportunity will bring. So much narrower, I would say now.
Yeah, there's a couple of things I'd like to unpack with both of you a little bit. The asset versus the platform focus. I think that's an important one. Before, maybe answer that or bring that into the context of the question, which is, you're pioneers in this field. Everybody in the cell and gene therapy space is effectively kind of a pioneer in terms of commercialization. I know we talk about and have spoken for the past years about the pipeline, the approvals. ARM does a really nice job with their reports, and everybody follows those. Adoption is the next hurdle, I think, driving that. I'm not going to go there yet. But investors have gotten more sophisticated as well. Do you think that's true? Or what do you think about the investors joining us on this journey?
So I'll start by saying that I think investors have always been sophisticated. They maybe have been less discriminating previously, right? That when everything goes up, you know, it's easy to invest. In this environment where almost everything's going down, they're becoming a lot more picky. I would say that it's hard to be empathetic with investors, all right? But just to set the stage, there's a lot of investors who are concerned about job security right now, that they've underperformed their portfolio versus others, that they're getting a ton of redemptions from their limited partners. We've even heard that, you know, there's some funds looking to shut down pretty soon. It's hard to justify to a limited partner who could invest in, you know, bonds or in, you know, fixed income or gold, for that matter, which may be preferable in this environment to risky assets. You know, these guys are worried. And so a lot of them are more focused on things like quick flips, that they can, you know, juice their portfolio by, you know, 25% in the next quarter based on a phase 3 result. That's not going to happen investing in a platform company, right? So I think we just have to understand that investors are hurting right now as well, and there's a reason why they're behaving the way they are.
I think, you know, investors are very logical. I think we have to look at, one of my first experiences in industry was actually going and selling, and one of the important things is understand your customer. And at the moment, it's very tough to be an investor because you're very worried about both the financial risk as well as the high risk of the science that we're engaged in. So in addition to the proposition of the investment, which in a high-risk environment, there are other places to place money. I think the other thing that we also have to recognize is some of the early launches, being early launches, were not necessarily textbook. And I think, you know, one of the things that's happened in the last few years, and it's a really rapidly evolving space, is the knowledge and the ability and capabilities to do the things like deliver products, to manufacture products, the cost of goods. All of these types of things are coming down. So I liken this industry, and I know it's a very bad cliche, to basically your first mobile phone, where it was clunky, clumsy, wasn't necessarily the easiest thing to do. I think that some of the investor sentiment was also that some of the big pharma companies came in to certain types of products, tried to launch them and struggled. But should we be surprised? Those of us who actually work in the area, it's much more important to have knowledge in the area than to have the size of the organization to actually deploy. I mean, what you will do is, in a big organization, you can throw lots of resources at things to fix things like manufacturing. But I don't think some of the early launches were also particularly well done. And that's also, I think, weighed on the sentiment. So I think that, you know, reasons for optimism is that even with those very difficult initial experiences, 14 out of 15 big pharma companies, top pharmaceutical companies, are actually heavily engaged in cell therapy. But it is something like the antibodies, where it's something that you have to learn, you have to build expertise, you have to build capabilities. And I think that that's one aspect which will take some pressure off of the investment in the sector, because we will start to see successes, I believe, in the near term. We've already got 2 $1 billion products. I think, you know, we're on track to have Tim's slides from the first day were, I think, 5 $1 billion products by 2030 and 20 between 500 and 1 billion. So the commercial success will come, and I therefore think that will be one weight which will be off the investors, and then it really will come down to the macroeconomic climates and actually investing in those companies that you could see are going to make a profound difference to society.
Right. And going back, we talked quite a bit about stage-specific investments and the right timing for the different types of investment. And you've both been very successful in fundraising as well as the follow-ons. public versus private, what drove some of those decisions?
Well, I mean, for us, we had to go public because we just needed that quantum of capital that's very difficult to raise privately. But I'll contrast that with the last round that we did, it looked a lot more like a private round than a public round. We invited a new investor named Reid Hoffman, who founded LinkedIn and PayPal and is a board member at OpenAI. He's a billionaire and very passionate about science and certain approaches. And he came in with a $38 million check alongside IRA Capital, who's been very faithful to us, towards a pipe financing. So that was a way that we could tap an alternate source of capital, I guess, atypical for public market, but someone who is passionate long-term about the space and hopefully very sticky capital.
Yeah, so impact investors will play a significant role in kind of this next phase that we're facing. So Chris, you, same?
Yeah, so if we look at the types of investors that are now in the space, we've heard actually at this meeting, which is very interesting, that different types of investors are now actually beginning to invest in the space. So one thing that I found quite interesting was hearing earlier that venture capital is now coming into public companies. We've also seen sovereign wealth funds coming into companies. One interesting thing that's happening that's supported by the industry in the UK is actually freeing the regulations so that pension funds can actually invest more in pharmaceutical companies. We, early in the life of Autolus, actually chose to go to NASDAQ. Chose to be a private, go from private to public company. Reasons for that was the quantum of the cash we needed to invest. We also needed to be in a stock market where there were specialist investors who would not necessarily come and go like the tide, but could actually stay with us for the longer term. So that was a very conscious decision and definitely the right one at the time.
Yeah, I think that's an important point that both of you have commented on. The relationship with the investors is critical. Having that, it's not a handshake and walk away. They're there for the duration, and managing that relation on an ongoing basis is pretty critical. So you've had that experience.
Yeah, I think trust is paramount in this environment. I mean, when I first came in as CEO, I wanted to set the rhythm that I would tell the board warts and all what's going on. And I think they really appreciate that transparency. I also think investors in this market are all facing, really poor portfolio valuations, but they want to really hear exactly what's going on. And if there's any sign of bullshit, then they're going to call you out for it, right? So we've been, that's the approach we've taken. I think there was some resistance because certain people wanted us to spin things different ways, but I think in the long term it paid off.
Right. And Chris, in the public markets, you have less.
Well, I think maybe two things. Firstly, a call out for the founder of Autolus, which is Syncona, which was spun out of the Wellcome Trust. And one of the things I will say is that great thanks to them, that the right investor can really help to found a company. The fact that they were evergreen, the fact that they were looking for a long-term inflection in value and to bring the products to patients really helped us. I do think as well that one thing that is really critical and one piece of advice is you don't come to a need for a raise and then engage your investors. These things are really prepared actually rather between the raises and actually maintaining a good relationship and an open, transparent understanding of what's happening in the company and an execution on what you promised that you would actually use the funds for. So I think probably as much preparation goes in between raises as actually at the raise itself.
Yeah, I think the sentiment is everyone's always raising, right?
Yeah, that's true. I'll put in a plug that, so IRA Capital is one of our biggest investors. They actually have a slide deck on their website about board presentations and particularly something they call an elephant slide. For those people who don't know what it is, essentially it's a single slide that provides a snapshot of going from your current cash balance all the way to where your true value creation milestone is. And it naturally tracks negative, right? But it shows exactly the amount of capital you need to get to that value creation point, and then milestones along the way that are necessary to achieve that. And so it maps out capital requirements, significant milestones, and ideally, it's also obvious what inherent risks there are to these milestones, all in a single slide. We use it at every board meeting. We use it between board meetings as well. We even use it as a guidance internally within the company. And so I think a really important tool as you're thinking about fundraising and how to best represent to investors.
Maybe a quick show of hands for those of you in the audience. How many of you are raising money now for your company? Okay. And how many investors are in the room now? Okay. So I guess part of the question that I'm coming after is, for giving advice to being successful investees, I think, and then giving advice to your peers, the other methods of fundraising. So whether you're currently have raised and are looking to bridge or looking for mezzanine rounds, what has your experience been? What's the market condition right now for those types of things?
So I could go through some of them. When we did it, I can't tell you the conditions now. The mezzanine round was really important. We went from 3 British investors to 6, including crossover funds, including one of the groups was Google Ventures. That was a necessary step to prepare for the IPO. So that was, I think, an activity that was helpful to, if you like, validate and anchor the move to an IPO. We've had 2 other types of relationship. We obviously have one which is project-based funding, and great thanks to Blackstone. That was essentially the money that we needed to build the commercial manufacturing facility and get our product to market, and clearly that was worthwhile for both parties. So that was actually, I think, a very useful way to raise the necessary capital to actually become a commercial company. And then we have a relationship with BioNTech, which is quite complex. It has certain engagements in products. It also has some elements of research evaluation in terms of potential future projects. I think, if both of those are really legitimate ways to raise capital. With the first, you're obviously diluting the asset as opposed to diluting the company, but you have to work with your board to see if that's the right thing to do. The second thing, I think, when we look for partnerships, we look for a partner who can actually bring not just money, but additional capabilities. Because one of the things being a biotech, sometimes you don't want to build capabilities in every area. So working with a partner who has complementary skills, I think, is a very attractive way to do both raising money, but also potentially expanding your value proposition by bringing in new capabilities and working together collaboratively on future value creation.
What I've seen is that if you're early stage, so very preclinical, there seems to still be a fairly robust market there for those investors, whether it's angels or early stage VCs. I think maybe part of this philosophy is that it's a little bit more sheltered, and you can have a low burn rate, make some good progress for the next few years while the environment has time to improve. That becomes very different when you head into the clinic. And I think the biggest reason why is that there are a lot of parallel companies who are already public, who are trading at cash or below cash, that you are going to be compared against. And so there's this dichotomy, right? Like, you've got early stage companies raising $50 to $100+ million out there. You also have Series C companies who right now have median valuations of 90 million or less. That's not quite compatible, right? And then you've got public companies trading at cash or below. So very weird dynamic. It either means one side is overvalued versus the other, I won't make a comment on which one, but I think it depends on the stage of company. But I just want folk to be hyper aware that once you're heading into the clinic, you're going to be benchmarked very differently.
So again, we're short on time. I'm thinking a little bit about the intangibles that also made you successful in your raises. What are some of the things you might point to? Obviously, the relationship with the investors you've both commented on, team, camaraderie amongst the team, ability to partner. What are some of those things?
So I would raise two things, and thank you for raising one of them that didn't come up before now. But the first thing I'll raise is timing. It's really important to raise at the right time. So you can never be complacent. If the opportunity is there to get you to the next milestone, you move and be ready. The second one you mentioned, and I'm culturally challenged because I'm both British and Swiss, but you have to also, you mentioned it, sell the team. Why does, because we've heard it actually this morning, we heard it actually in a private meeting yesterday. Basically, when they invest in a company, they're investing in the science and they're investing in the people who they believe can take the science to the next step. And I think, particularly if you're European, you're culturally challenged to put yourself out there and say, this is why I believe I think I could do it. But I think it's really important to also have the credibility of the people as well as the product and the science.
Yeah, I would say that aside from the relationships that we've talked about, your team's really important. If you're CEO and you think that you can do 90% of that heavy lifting, you know what? You're probably not a great CEO. You need to be surrounding yourself with people who are smarter than you, with more specific expertise, who are really credible in front of investors. Those are all mutually exclusive things, by the way. And to have that team shine in front of investors alongside your presentation, I think is really important. I think another point I want to make is that syndicate is also really important. All the more now, there's a herd mentality. And so if an investor is leading in, that's awesome. Start putting pressure on that investor, say, you know what? Which of your buddies should we be calling, right? Can you please make an introduction to so-and-so? I know you've made this investment with these guys co-leading. I'd love to get an introduction. I think that getting them to do some heavy lifting and even potentially taking on some reputational risk, you know, I think it's reasonable to ask. They don't have to agree, but you should ask.
So there we have a number of pieces of the secret sauce that has made you successful. Being a glass half full or mostly full person, what are you guys optimistic about over the coming months?
So for us, it's really clear our future is in our own hands. We need to execute on the launch and actually show that a small company can be successful in the market and can also make it a strong business case. I mean, one of the things that's really important is that we need to also raise the bar in terms of, you know, what will success look like, because we need to build a product to peak. So we're actually looking, not just at the launch, but beyond the launch. So I'm optimistic about the fact that people need our products. If we have a good enough product and you have the capabilities to deliver it, you can be successful. And then I have a Christmas wish that the world stabilizes a bit and it's an easier environment to work in.
Yeah, what's on your wish list?
So I'll put a plug in for ARM that we are actually undertaking a specific project focused on helping companies like yours raise money in this difficult financial environment. It's something that we just had a CEO roundtable just now centered around this. We actually have a very extensive slide deck that's being developed. Tommy Majors at ARM has really been spearheading this, and it's fantastic content. Now, it is somewhat generic, just to put a caveat, because it is across our sector, cell and gene therapy, but there's some amazing content in there that we hope will be supportive to your fundraising processes. This is something that is currently available to board members to get their feedback, but will shortly be available for our members. So if you're not a member, I would sign up right now. And we'd love your feedback on this content.
Oh, great. So with that, we are at time. I wish we could have unpacked a lot more. These gentlemen are obviously certainly well experienced and credentialed, and thank you for sharing your information and wisdom with the crowd. And it's been an absolute joy to talk to you today. So please join me in thanking them.
Thank you, Phil.
Well done.
Great. Thanks.
Really great job.